Hello and welcome to the fourth in a series of videos brought to you by I2C as part of the 101 Bootcamp series. I'm Roger Spain. I'm with Warren Averett, a CPA firm with offices throughout the Southeast. I work in our group that provides outsourced accounting services, and I think I've told you before if you've been watching, but I offer that so that you'll understand the perspective from which I'm coming as I offer some of these thoughts. In the first three videos, we've walked through the basic components of financial statements, how to read them and what they tell you and what they mean. And in the third video, the most recent one, we talked a little bit about some of the complexities associated with financial statements, what the limitations are, and we got a little bit into accrual versus cash accounting, and then how to close out an income statement on an annual basis and move into the next fiscal period. So today, and I teased and promised in the last video that we would get into debits and credits, and today's the day. So I'm going to offer this to those who have the stomach to sit through it, and I promise you I'm going to move fast, and at the end of this you might be able to do some of your own accounting, but at a minimum I think you'll have a good understanding of what language your accountant is speaking when you hear them talking about debits and credits. So very briefly, let's go back over a couple of very important equations, three very important equations. One is that the basis and the premise for all of this is double entry bookkeeping. That is, debits equal credits, and it's a zero-sum game. If the net of debits and credits is not zero, we've done something wrong and the books are not balanced. So know that when we talk about double entry bookkeeping, every single transaction has two entries, one that's a debit and one that's a credit. And think of debits as pluses maybe and credits as minuses. And that way you can think about them equaling out, getting to zero. Next, the important equation to think about is that in the income statement, income minus expenses equals net income. We know that. That's pretty basic. The next important equation is that assets equals claims on those assets in the form of third-party liabilities and owner's equity. Keep those three things in mind as we move through this, and we're going to talk about debits and credits for just a minute. The first thing that I'm going to ask you is that you suspend everything you've been told about debits and credits by your bank. And I'll tell you why. And I think this will help you a lot in getting to where we need to be with a basic understanding of what is a debit and what is a credit. If we think about debits and credits, I want you to first be aware that assets carry debit balances. To increase assets, we debit an asset. So if you get cash, you're going to debit cash to increase cash. And if that cash came from a bank that you borrowed it from and you owe the bank that money, you would credit the liability. So we've got a debit to cash and a credit to liability or the bank. And they balance 100 and 100, debit and credit. And what banks do when they talk to you about crediting your account and use that sort of language, they're talking to you from their perspective. So when you make a deposit at the bank, let's leave your books aside for just a moment. When you make a deposit at the bank, you put $100 in the bank, and that's your $100. And the bank accepts that $100, but they owe it back to you. So it's a liability to them. When you put money in their bank, they have a liability to give that back to you whenever you ask for it. So when you make a deposit into your account, it increases their liability to you, and they owe you more. And therefore, they credit that liability to make it bigger because they owe you more money because you just made a deposit to put more money in their bank. So when they tell you they're going to credit your cash account to increase your cash account by crediting it, they're speaking from their perspective. They're saying, our liability to you has just gone up, so we're crediting your account, recognizing a larger liability to you. So that's the first thing I want you to know is when banks talk to you about crediting your account, They're selfishly doing that from a personal perspective, from their own perspective, and not from yours. So now if we think about this, we know that debits and credits have to equal one another. And we just talked about the fact that assets on your books are represented by debit balances, and liabilities and owner's equity, because those have to balance, right? Assets have to equal the claims against the assets, whether it's third parties or equity. Those numbers all have to be credits. The liabilities and owner's equity are credits against those assets. On the income statement side of things, we also have to recognize that one of those is a debit, and one of those is a debit balance, and one of them is a credit balance. And in this case, because we talked about in the last video the fact that net income becomes equity, the net income or the income carries a credit balance because we just said owner's equity carries a credit balance. And so that's going to have to increase the credit balance of owner's equity. The net income will. Therefore, income is a credit and expenses are a debit. So as we think about all this, I've tried to resist the urge to go through and draw out entries and rather present this to you in a format to help you understand that debits and credits must equal. And in the end, on the balance sheet, the assets represented by debit balances have equal claims or credit balances against them, whether they're third-party liability credit balances or the residual owner's equity credit balance. But they equal, they balance. And if, as in the last video we talked about, that owner's equity is increased by net income, then we know that the income must be a credit and the expense must be a debit. So hopefully this is a help to help you understand, first of all, that banks have been speaking to you from their perspective, and I need for you to suspend what you've learned, what you've heard from banks in terms of debits and credits, and instead think about it in your own terms, where you get to think of assets being debit balances, liabilities and equities being credit balance, and if owner's equity is a credit balance increased by net income, then income must be a credit, with the expenses being the debit to reduce that credit income balance. I sure hope this is a help, and if it is, then that's fantastic, because you've learned a lot about accounting in a very short few minutes, whereas many of us had to sit through a semester in college to get comfortable with this. So if this is a help, that's great. If not, well, we tried, right?